The $1.1 million you're accidentally not building. Here's a number that should bother you. 47% of Americans arrive at age 55 with less than $50,000 in retirement savings. Not less than they planned for. Less than $50,000 total at 55. When you hear a figure like that, the natural response is to assume those people made catastrophic mistakes. They gambled. They quit their jobs. Something dramatic happened. But that's not what happened to most of them. Most of them were ordinary. They earned ordinary wages. They paid ordinary bills. They made ordinary decisions about money for 30 years in a row, and 30 years of ordinary decisions produced a number that is, by any reasonable standard, a financial crisis. The difference between where they ended up and where they could have ended up is not talent. It is not luck. It is not even income, at least not mostly. It is compounding time that no one ever started. This video is about starting. Specifically, starting in your 30s, which is when most Americans actually confront their finances for the first time with any real seriousness. It is about the math behind that decision, the behavioral traps that delay it, the debt structure that makes it harder than it should be, and the system that either works for you or against you, depending almost entirely on choices you can make in the next 90 days. Let's talk about what the numbers actually say. Problem 1, the lost decade. Every personal finance book in existence will tell you that the most powerful force in investing is compound interest. They will show you a chart where 22-year-old Alex invests $5,000 a year for 40 years and retires with $2.1 million, while 32-year-old Jamie does the same thing for 30 years and retires with $900,000. The books use this comparison to scare you into action. What they don't tell you is that the lost decade math works in both directions. Yes, starting at 22 instead of 32 is worth roughly $1.2 million over a lifetime, assuming identical contributions and a 9% average annual return. That number is real. But here is what is also real. Starting at 32 instead of 42 is worth roughly $800,000. And starting at 32 instead of never is worth $1.1 million. The people who spend their 30s feeling guilty about not starting in their 20s are making a mathematical error. They are comparing themselves to a hypothetical better version of themselves who doesn't exist, instead of comparing themselves to their actual future self, who might never start at all. In the United States, the median retirement savings for Americans between the ages of 35 and 44 is $45,000. The average is higher, pushed up by a small number of people with very large balances. But the median, the actual middle number, is $45,000. If you are 32 years old with less than $45,000 in retirement savings, you are not behind the average American in your age group. You are the average American in your age group. That is either reassuring or terrifying, depending on how clearly you can see what median retirement savings at 44 actually produces. $45,000 invested at 9% for 20 years, the time between 44 and 64, grows to $272,000. The Social Security Administration's projected average benefit as of 2024 is approximately $23,000 a year. So, the median American at retirement is looking at Social Security plus whatever 4% of $272,000 can produce, which is about $10,000 a year from investments, $33,000 a year, before taxes on the Social Security portion, in retirement. This is not a personal catastrophe, it is a systemic one, and it is playing out in slow motion across the entire country. The compound interest calculation that will change your life is not the one that tells you how much you lost by not starting at 22. It is the one that tells you how much you gain by starting today. If you are 32 and you invest $600 a month in a diversified index fund tracking the S&P 500, earning the historical average annual return of roughly 9 to 10%, you will have approximately $1.1 million by age 62. That is not a projection. That is compound interest arithmetic run forward 30 years. $600 a month sounds like a lot, and for a significant portion of Americans in their early 30s, it is a lot. That is exactly why Problem 2 exists. Problem 2, the American debt machine. There is a specific financial architecture that most Americans in their 30s have inherited from their 20s, and it is extraordinarily effective at consuming every dollar that might otherwise go to wealth building. It has three main components. The first is student loan debt. The average federal student loan borrower in the United States currently owes $38,000 at graduation. The average monthly payment on a standard 10-year repayment plan at current interest rates is somewhere around $400. $400 a month for 10 years is $48,000 paid back on a $38,000 loan, meaning roughly $10,000 of that is interest. $400 a month for 30 years in the S&P 500 would produce approximately $730,000. That is not what happens to that $400. What happens is that it disappears into the debt repayment machine that Americans agree to at 21 years old when they are not yet capable of understanding the trade-off they are making. The second component is the car payment. The average new car payment in the United States as of mid-2024 is $735 a month. The average used car payment is $523. These numbers have risen dramatically over the past 4 years as car prices surged during the supply chain disruptions of the pandemic era, and they have not come back down. $735 a month in a 30-year-old's budget on a car. Let us be precise about what that represents. If you are paying $735 a month for a car on a 5-year loan and then immediately replacing it with another 5-year loan when it expires, which is what most Americans do, you are committing yourself to paying $735 a month for cars, essentially forever. That is $8,820 a year. Over 30 years, it is $265,000 in car payments plus interest. $735 a month invested in the S&P 500 for 30 years produces $1.8 million. The third component is rent versus ownership. In 2024, the median home price in the United States crossed $330,000 for the first time in history. Monthly mortgage payments on that median home, assuming a 20% down payment and a 7% interest rate, are approximately $1,760 per month. The down payment required to even access those terms is $66,000. For a 32-year-old with $45,000 in total savings, the standard path to home ownership is not available without significant assistance, so they rent. Median rent for a one-bedroom apartment nationally is approximately $1,380 a month. They are not building equity. They are paying for shelter with money that will never come back to them. None of these three things, student loans, car payments, rent, are signs of failure. They are the standard financial architecture of American adulthood. They are so normalized that most people do not see them as choices. But they are choices, and they carry enormous opportunity costs that are almost never discussed at the moment the decision is made. The person who enters their 30s with $80,000 in student debt, a $700 car payment, and a $1,200 monthly rent is not irresponsible. They are ordinary, and they are being consumed. The math changes when you start treating these not as fixed costs, but as variables to manage. The average American who drives the third most expensive car they could qualify for, instead of the most expensive, saves $200 to $300 a month. Multiplied over 30 years in an index fund, that is a difference of between $300,000 and $700,000 at retirement. $200 a month, one car buying decision. This is the scale of what is at stake in the choices that feel small in the moment. Problem 3. The behavioral tax. There is a gap between what Americans know about personal finance and what they actually do, and it costs them more than the debt does. A 2023 survey by the National Financial Educators Council found that only a minority of Americans could pass a basic personal finance quiz. But financial literacy alone does not explain the wealth gap. Some of the most knowledgeable people in finance are also some of the worst savers. Something else is happening. Behavioral economics has a name for it: present bias. The human brain is structurally better at valuing things that are immediate than things that are distant. A dollar today feels larger than a dollar in 30 years. A vacation next summer feels more real than financial security at 65. Groceries right now feel more urgent than index fund contributions that won't be spendable for 3 decades. This is not weakness. It is how mammal brains are wired. The problem is that mammal brains evolved in environments where the future was uncertain enough that present bias was adaptive. You ate when there was food because tomorrow you might not find any. In that environment, consuming now was rational. In the modern financial environment, where the food supply is stable, the market has returned roughly 10% annually over a century, and the danger is not starvation, but running out of money at 72. Present bias is a catastrophic liability. Here is what present bias looks like in practice. In 2006, a team of researchers followed a group of employees who had been auto-enrolled in their company's 401k plan and compared them to employees who had opted in voluntarily. The auto-enrolled group had dramatically higher participation rates and contribution rates than comparable companies without auto-enrollment, but they had not been given more information. They had not been offered a better deal. The only thing that changed was the default. When the default was to not participate, most people didn't. When the default was to participate, most people did. The size of the decision, whether to build retirement wealth or not, was determined almost entirely by inertia. The behavioral tax is what you pay every year that your money sits in a checking account earning 2% when it could be in an index fund earning 9%. It is the difference between a HISA and a brokerage account. It is the contribution you did not increase when you got a raise because it felt complicated. It is the rebalancing you did not do. It is the Roth IRA you opened and then funded at $1,200 for 3 years in a row because you kept meaning to max it out. For the median American, the behavioral tax over a working lifetime is estimated at approximately $300,000 in unrealized investment returns. That is not $300,000 you spent. It is $300,000 that simply did not compound because the money stayed in places it should not have stayed. The single most effective intervention for present bias is automation. If the contribution never enters your checking account, you cannot spend it. If it goes directly from your paycheck into your retirement account, before you have ever seen it, you will adjust your spending to the amount that remains. This is not a controversial finding. It is one of the most replicated results in behavioral economics. And yet, automation rates among American savers in their 30s remain surprisingly low. The most recent data suggests that fewer than half of Americans in the 30 to 40 age bracket have automated retirement contributions beyond their basic 401k. That means more than half are relying on willpower and good intentions to build retirement wealth every month. And willpower is a depleting resource. Good intentions do not compound. Problem 4. The American system and how to use it. The United States tax code contains the most generous wealth-building tools ever constructed for ordinary wage earners. Most Americans use them incorrectly, partially, or not at all. Let's walk through what actually exists. The 401k allows you to contribute up to $23,000 per year in pre-tax income. If you are in the 22% tax bracket, that means the government is effectively subsidizing 22% of your retirement contributions. Every dollar you put in costs you 78 cents in take-home pay. The employer match, where it exists, is a 100% instant return on your contribution, up to the matched amount. The average employer match in the United States is roughly 50% of the first 6% of salary. If you earn $70,000 a year, that is $2,100 per year in free money, available to every employee who contributes enough to capture it. 35% of eligible Americans do not contribute enough to capture their full employer match. 35% of people are leaving free money on the table in an environment where free money is almost never available. The Roth IRA adds another dimension. Contributions of up to $7,000 per year, funded with after-tax dollars, grow tax-free forever. If you contribute $7,000 to a Roth IRA at 32 and never touch it until 62, that $7,000 becomes, at historical rates of return, approximately $112,000, entirely tax-free. You will not pay a single dollar in capital gains tax on $105,000 in earnings. The income limit for direct Roth IRA contributions phases out above $150,000 for single filers and $236,000 for married filers. For most Americans in their 30s, this vehicle is wide open and most of them are not using it. The HSA, Health Savings Account, is a third tool that barely gets mentioned in mainstream personal finance discourse. If you have a high deductible health plan, you can contribute up to $4,150 per year as a single person or $8,300 as a family pre-tax. And if you invest the balance and never use it for medical expenses, it becomes a triple tax advantage retirement account. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses, which become universal at 65, are tax-free. That is a better deal than the 401k. It is a better deal than the Roth IRA. And the majority of HSA account holders leave the money sitting in a cash equivalent position, earning almost nothing instead of investing it. Here is what the full system looks like when you actually use it. 32 years old, income of $75,000, contributing 15% of gross to 401k, which is $11,250 per year, capturing the full employer match, adding another $2,250, maxing the Roth IRA at $7,000, contributing the HSA maximum of $4,000. Total invested per year, $24,500. Total out-of-pocket after tax advantage, approximately $17,000. Projected balance at 62 at 9% average annual return, $2.4 million. $2.4 million from a $75,000 income. No side hustles, no stock picking, no cryptocurrency, no real estate speculation. Just the tools the United States government has explicitly constructed for exactly this purpose, fully utilized. The people who retire with dignity in America are not, on average, the people who earn the most money. They are the people who understood the system earliest and used it consistently. The median 401k balance for Americans between 55 and 64 is $87,000. The people who understood the system at 32 have balances an order of magnitude larger than that. And the difference was not income. It was time, discipline, and the quiet compounding of decisions made in a decade most people spend convincing themselves they will start next year. The outro. Here is what the math on all of this says in plain language. If you are 32 with very little saved, you are in the average American's position. The average American is on a path to a retirement that will be uncomfortable, financially constrained, and shorter than it needs to be. That is not fate. It is a trajectory. Trajectories change. The difference between the median American retirement outcome and the outcome that provides genuine financial security in your 60s is not a lifetime of sacrifice. It is a series of specific mechanical decisions. Automate your contributions, capture your employer match, open and fund a Roth IRA, increase the contribution by 1% every 6 months, drive the car you can afford instead of the car that impresses people who are also broke, and let the mathematical force of compound interest do the work that willpower cannot. The 32-year-old with $214 in their savings account, who starts investing $600 a month next January, will have $450,000 by 47. Not because they got lucky, not because markets cooperated perfectly, because compound interest is not complicated, and starting is not optional. The people who understand money are not richer than you because they know things you don't. They're richer because they started earlier, automated more, and paid less in behavioral taxes. All three of those things are available to you right now. Understanding money is your best defense. More on Money, USA.